The 5 most common potential tax traps that I see clients face in retirement are 1. RMDs escalating, 2. Social Security becoming taxable, 3. Medicare premiums increasing, 4. Estate tax issues when passing money on to the next generation, and 5. Unmissed capital gains or capital loss harvesting. Any one of these potential traps could hinder your retirement plans, and in today's video, I'm going to walk you through each of those 5 traps in detail, as well as steps that you can take to mitigate them on your path to retirement. Before I jump in, I just want to ask, if you enjoy our videos or find them useful, please feel free to like and subscribe to our page. As a financial advisor that's helped hundreds of families through their retirement planning over the years, I developed a framework that I'm going to outline today, and you can use as well. Please do not be overwhelmed when it comes to tax planning. By the end of this video, you're going to have a roadmap which includes actionable steps that you can take to help navigate your situation. The first thing I want to speak about, I've seen time and time again. The look of absolute shock on one's face when they've spent their whole life saving in pre-retirement accounts only to find out that they're going to have to take required minimum distributions at some point down the line. That look of shock typically comes from the fact that after saving diligently for all those years leading up to retirement, finding out that your required minimum distributions can actually push you into a higher tax bracket. Here's what happens. After all those years of saving and investing in pre-tax or traditional retirement accounts, Uncle Sam finally says he wants his cut. And you are forced, as it stands today at age 73, to start withdrawing from those accounts whether you want to or not. There is a small caveat to note here. And that is, if you are currently employed, you are age 73 or over and eligible to take RMDs, you do not have to take those required minimum distributions from your current employer retirement account. Other than that case, these withdrawals are largely unavoidable and unfortunately can really stack up over time, especially if you're taking income from other retirement sources or other investment accounts. Let me paint a picture for you. Consider this. A happily retired couple has accumulated $1.2 million in their traditional pre-tax retirement accounts. In their first year of RMDs alone, they could be forced to take out up to $40,000, irregardless of needing that money for expenses. Not only is that a relatively substantial sum of money to take out and add to your income for the year in one fell swoop, it's also important to note that RMDs are not a one-off situation unless you choose to liquidate your retirement account in one shot. That number could actually increase exponentially over time, because not only does the portfolio theoretically grow as the assets are invested, in addition to that, the percentage that you must withdraw increases as you age as well. So, for instance, at age 73, you could be taking out somewhere around 3.7%. Meanwhile, as you age and you grow past 80 or 85 or 90, that number could more than double over time. As I mentioned earlier, I'm seeing more and more retirees get blindsided by this phenomenon. And that's because most have lived their lives going by the conventional wisdom that you'll be in a lower tax bracket when you retire. For previous generations with potentially smaller retirement accounts who might be relying on solely pensions or Social Security, that wisdom could be true. But for current generations who've spent their entire lives saving and built up quite a great nest egg, that information is becoming increasingly false. What's particularly important to understand is that planning for this starts way before you actually reach required minimum distribution age. Once you hit RMD age, your ability to navigate these withdrawals in a nimble manner decreases significantly. It's kind of like installing a security system after your house has already been broken into. So often, people focus solely on how much they're saving for retirement in an effort to pack as much away as possible, giving little thought to where they're saving or how they're going to withdraw that money one day in retirement. The tax consequences associated with your withdrawal strategy can have a significant impact on how much money you actually end up keeping and allowing you to live your life comfortably in retirement. Let's talk about another situation that I actually see take many people by surprise as well. A little known fact, many of us rely at some point on the fact that we're going to take Social Security in retirement. But something that many of us don't understand is that a portion of that, or a hunk of it, could actually be taxable. In fact, up to 85% of your Social Security could be eligible for taxes. And unfortunately, many of us don't realize this until we get hit with our first tax bill. After you've already worked your entire life and have paid taxes and paid into the Social Security system, it could be natural to think that that money would come out tax-free. However, this typically is not the case. This calculation includes anything from your adjusted gross income to any non-taxable income you receive, plus your Social Security benefits. As it stands now, once your combined income passes certain thresholds, your Social Security starts to become taxable. For married couples filing jointly, once your combined income exceeds $32,000, 50% of your Social Security benefits are eligible to be taxed. Once you cross that $44,000 mark, 85% of your benefit is eligible to be taxed. For those filing single, those thresholds are even lower, $25,000 and $34,000 respectively. What can make this particularly problematic in certain situations is when this intersects with withdrawals from your retirement accounts. Each dollar that you withdraw from your traditional or pre-tax IRA or 401k doesn't just get taxed on its own. It also has the ability to push you into a higher bucket as far as your combined and total income for your Social Security benefit taxation as well. Consider this. A married couple is currently taking $30,000 in Social Security income. In addition to that, they're taking $25,000 from outside sources. Add on retirement benefits as far as IRA distributions are concerned for another $20,000, and now they hit the $45,000 number where 85% of those benefits are taxable. As I mentioned earlier, this problem can actually be compounded by traditional retirement planning advice and saving in pre-tax accounts. Although you might be receiving that deduction on your income up front for your contributions, it could create a nightmare later on down the road. In understanding this, there are steps that you might be able to take to lessen the blow. And I'm not talking about any crazy loopholes or aggressive deductions. I'm talking about changing the way you think about your retirement savings and potentially executing Roth conversions. Let me walk you through what that means. A Roth conversion consists of taking money from a traditional retirement account and converting it to a Roth retirement account, essentially changing when you'll pay tax on that money. With traditional retirement accounts, you receive a deduction on your income up front, your earnings grow tax deferred, and you pay taxes on any money that you withdraw. With a Roth, you don't get the deduction up front, but any potential earnings and withdrawals in the future are tax-free. Here's where the magic happens. By strategically converting portions of your pre-tax retirement into Roth accounts in the years leading up to reaching RMD age, you might have the ability to lessen the blow when you do have to take RMDs out. The timing of these conversions can be crucial as well. In an ideal world, you'd want to do them in years where your income is lower in comparison to your working years. So this could be, if you're fortunate enough to retire prior to RMD age, all of the years added up before RMD age. Instead of waiting for RMD age, they could consider implementing a 10-year Roth conversion strategy whereby they convert $50,000 a year each year for 10 years into a Roth account. Yes, although you'll pay taxes on that money now, you might theoretically be at a lower tax bracket. In addition, you've converted $500,000 of pre-tax money into Roth money over that period of time, which again could grow, and any withdrawals that you end up taking out are completely tax-free. What I like about this strategy is that it addresses multiple tax situations that we spoke about earlier. Not only through these conversions could you potentially reduce or even eliminate your required minimum distributions, you'll also now have a tax-free bucket of money to use in retirement, which could provide you with more flexibility. This also loops back to what we spoke about right in the beginning, in that you might be able to navigate the situation where you're able to stay under those critical total income thresholds for Social Security. The beauty of the multi-year conversion is it allows you flexibility in how you convert, which can also allow you flexibility in your tax situation. Methodically choosing different amounts each year in order to keep yourself under those crucial tax brackets can become key in the long term. One important thing to take note of: a Roth conversion is not an all or nothing strategy. As I just mentioned, you can do this over the course of a period of time in order to try to keep your tax consequence to a minimum. Tax planning is about finding that sweet spot that works for you in your situation. And remember, it's not a one-off event. It's something that moves as time goes on and requires regular evaluation. Those years between when you stop working and start having to take required minimum distributions can be prime for an opportunity to make conversions. And for more information on Roth conversions, check out our next video here.